You can be right and still lose money. Not once, not occasionally, consistently. In fact, some of the worst performing traders in the world are right more than half the time. That's not a paradox. That's the system working exactly as designed. Let me drop you into a familiar scene. You spot a trade. The logic is clean. The chart agrees. The news lines up. You enter. The market moves against you. Just a little. Enough to hit your stop. You're annoyed, but calm. Because hours later, the market turns. It goes exactly where you said it would. You were right. Your account balance disagrees. And after a few months of this, a quiet thought creeps in. Maybe the market is rigged. Maybe you're unlucky. Maybe you're missing something small. You are. But it's not small. It's invisible. And it's the reason most trades lose even when the direction is correct. Here's why this matters right now. Retail participation in markets is near historic highs. More people are trading stocks, crypto, forex, options than ever before. Apps made it frictionless. Social media made it loud. Everyone is talking about entries. Almost no one is talking about exits. And even fewer are talking about the math that quietly eats accounts alive. So let's strip this down. No indicators, no gurus, no motivational nonsense. Just the mechanism. Imagine a simple game. You flip a coin. Heads you win, tails you lose. But here's the twist. When you win, you gain $1. When you lose $3. You can be right 60% of the time and still go broke. That's not trading theory, that's arithmetic. And most traders are playing this exact game without realizing it. Let's talk about the hidden reason. It's not direction. It's not analysis. It's not even discipline, at least in the way people think. It's asymmetry. The mismatch between how much you make when you're right and how much you lose when you're wrong. Most traders focus obsessively on being right. The market doesn't care. The market only cares about payoff. Here's what typically happens. A trader risks 2% of their account on a trade. They aim to make 2%, a 1-to-1 reward-to-risk ratio. Sounds reasonable, feels responsible. But reality interferes. Spreads, slippage, fees, late entries, early exits. That 2% gain becomes 1.6. That 2% loss stays too. Already, the math is tilting. Now add psychology. When the trade goes against you, you hesitate. You don't want to be wrong. You widen the stop, just a little. When the trade goes your way, you feel relief. You take profit early, just to be safe. Losses stretch, wins shrink. Direction stays correct. Outcome deteriorates. And over time, something subtle happens. You start winning more often and losing more money. This is where irony enters. A trader with a 40% win rate but strong asymmetry can grow an account steadily. A trader with a 65% win rate and poor asymmetry can destroy one beautifully, slowly, quietly, painfully. But there's another layer. This one is even harder to see. Volatility drag. It sounds academic. It's not. Here's the simplest version. If you lose 50%, you need 100% gain just to break even. Losses hurt more than gains help. That's not emotional. That's math. Now imagine a trader who risks too much per trade. They lose 10%, then gain 10%. They are not back to even. They're down. Repeat this cycle during choppy markets, which is most of the time, and the account decays even if the trader's directional calls are solid. The market doesn't reward being right eventually. It rewards surviving continuously. This is where most people misunderstand timing. They think timing means entry precision. Timing actually means exposure duration, how long you are vulnerable to randomness. Markets spend far more time being noisy than being directional, so even correct ideas can be wrong trades, because the path matters more than the destination. And here's the uncomfortable mechanism most traders never model. Drawdown recovery. If you lose 20%, you need 25% to recover. Lose 30%, you need 43%. Lose 50%, you need 100%. At some point, the required performance becomes statistically unrealistic. Not impossible, just unlikely. That's where accounts die, not from one bad trade, but from the compounding weight of asymmetry, volatility, and exposure. Now let's contrast hype versus reality. Hype says, find better entries, get a higher win rate, predict more accurately. Reality says, structure your losses, control your downside, accept being wrong, often. The best traders in the world are not precision snipers. They are risk managers who occasionally get lucky. And the worst part is, most trading education reinforces the wrong obsession. Screenshots of entries, highlighted arrows, called it captions. No one posts the full equity curve. No one posts the risk profile. No one posts the distribution of wins and losses. Because that's where the truth lives. And it's boring, and it doesn't sell dreams. Here's a quiet example. Two traders, same market, same idea. Trader A risks 1% to make 3%, wins 35% of the time. Trader B risks 3% to make 1%, wins 65% of the time. Trader A grows slowly. Trader B feels brilliant, until they don't. When volatility spikes, and it always does, Trader B's account doesn't survive the drawdown. Trader A barely notices. Being right didn't save Trader B. Structure did. Now zoom out. This isn't just about trading. It's about how systems reward behavior. Markets don't reward intelligence. They don't reward effort. They don't reward conviction. They reward alignment with probabilistic reality. And humans are terrible at that. We hate small losses. We crave frequent wins. We avoid discomfort even when it's optimal. So we build strategies that feel good short-term and collapse long-term. And when they fail, we blame ourselves, or the market, or manipulation, rarely the math. So here's the unresolved question I'll leave you with. If you can be right and still lose, then what does being right actually mean in markets? Is it predicting direction? Or is it surviving long enough for probability to work in your favor? Most traders never answer that question, and the market answers it for them.